Takes.
Hey everybody, welcome to a makeshift version of Two Takes. I'm Chad Reidlinger.
I'm Howard Vernick.
We're joining you live via satellite from our humble abodes, and but we just couldn't.
Being socially responsible. Not being
What's that? Where's your?
I say
you
we're
have
being
your
socially
lotion around there? You got your hand sanitizer sitting right by you?
I got it right behind the camera.
But we wanted to make sure that we continue to meet with you guys and bring all real estate and mortgage news to you guys. And so this week we're going to open up. Let me go ahead and we're doing this a little bit different, but let me go ahead and share my screen. And we're going to go through the topics today, and we're going to be able to actually show you some of the stuff that we're talking about. So topic number one is the Fed announced unlimited purchases of the MBS and treasuries, and they added multifamily mortgages. So Howard, what was this all about, and how is it going to help our lending economy?
So what happened to our economy is that liquidity seized up and banks couldn't borrow money from each other. So the Fed had to step in and change some of the rules on how they borrow money from each other, and then loosened up on these securities and said they're going to buy these securities to bring more money into the market.
That the real estate industry gave them all the information
and keep the economy rolling. So they first said they were going to do $700 million between purchasing mortgage-backed securities and buying bonds and treasuries. Now they're saying they're going to buy an unlimited amount. So they want to keep the economy rolling by keep on flooding money into the market. And the big thing that they also said that they were going to do is as they paid off loans, they're not going to take that money out. They're going to repurpose that money also back into the market. So they really want to keep this economy rolling.
Yeah, I saw the article went on to say that they were purchasing $125 billion per day. They were going to allocate $75 billion towards treasuries and $50 billion per day towards MBS securities. So I mean, look, they're doing what they can, right, to continue to keep the rates good for consumers. I think that's really important. The article actually also went on to talk a little bit about where they think rates could be come fall this year, and back into the low threes again, possibly even below 3%. So a lot of that to me tells me why we've seen investors cautious even when we see big dips in the mortgage rates to follow suit, because they don't want to have all that runoff come end of the year.
Well, between capacity and our economy, the rates are it's crazy. They're up and down during the day. Lenders are shutting off their lock desks, and nobody really knows exactly what's going to happen. And so this is why it's so chaotic right now. But I'm hoping, and what I'm hearing is that this is not going to be a long-term issue. It's going to be more short-term issue, and hopefully the shorter the term, the better. Absolutely.
So I don't have a timer in front of me, but I'm feeling like that was like 2 minutes. So we're going to go ahead and transition to we don't have Paul in the background, like being like
my watch.
Number two here, we have the FHFA announced two new policies designed and designated to help with the coronavirus and to help the mortgage markets. And so those were surrounding appraisal requirements and around verbal verification of employments for closing. So Howard, you want to talk us through these items as well?
Yeah, so on the verbal verifications of employment, we do this right now. Fannie Mae rules and Freddie Mac are that 10 days prior to closing, within that time period, we have to call employers to make sure that people are still at their jobs. Now that people are working from home and it's much harder to get in touch, they're kind of changing those rules a little bit, although different lenders are going to be even a little bit tighter on this because we are expecting such a large amount of layoffs. So we're cutting those times down to 3 days prior to closing, where we're calling to make sure that the company's still open, person's still working there. Now they're also letting them use email to verify, and Fannie and Freddie are allowing us to get pay stubs or bank statements showing deposits after closing. I think that's a little bit loose for a number of lenders, but certainly the calls, and they'll allow emails to make it easier for us to make sure that people are still at their jobs.
It's a little late after closing to find out, oops, like, yeah, we had
Right.
that bank statement, but oh, I was let go, after that statement was cut. And
Yeah, no, it's silly.
I think too, we're going to see, it's one thing for Fannie and Freddie to put this stuff out, or for the FHFA to put that out. But at the same time, like you said, investors might come out with different guidance because, they just don't feel comfortable with as loose of those guidelines are. So I think,
It's like anything. We're making loans. We want to make sure that we don't get people in trouble. We want to make sure they can make the payments. We went through the 2008, 9, and 10s where people bought houses that they couldn't afford, and we don't want to repeat.
Right. So yeah, I mean, you see here the pay stubs and the bank statements, even though they're in the letter, but the calls and emails are what we kind of see the investors running with and allowing. But obviously, you'd want to talk to your company and see what your company allows. And then also, Howard, talk a little bit about what I have up on the screen here with the appraisals.
Right. So now that we have this pandemic, appraisers don't want to go into people's homes, and people don't want appraisers to go into their homes.
Right.
So Fannie and Freddie came up with guidance around this, and for purchase transactions owned for principal residences, they're allowing a regular appraisal if you want to do that. They'll allow a desktop appraisal or an exterior only appraisal so the appraiser could just drive by. They're allowing it for second home and investment properties when you're borrowing less than 85% of the value. And on second home, and then on investment properties, but if they're a cash out refinance or a limited cash out refinance, those they're asking for regular appraisals unless it's a limited cash out refinance and Fannie Mae currently owns that loan. So there's different situations depending on if you're buying the property as your primary residence, a vacation home or investment property, and how much money you put down. And again, here they're trying to limit how much people have to interact with each other and how close they get to each other. And to be perfectly frank, people don't want people in their house that they don't know.
And I think this is a good thing to try to continue to keep the market moving with refinances, people being able to get access to the equity in their homes if they should need it, especially with what we're going through right now. So I think this is good direction that they're providing here, and a good solution to keep things kind of moving in the right direction, so to speak. And this is obviously all based on the cities and local municipalities being able to continue to administer these closings and things getting recorded in timely fashion. But I think this is good. This is good. On behalf of Fannie Mae putting this letter out and allowing these looser guidelines surrounding the appraisal.
And people still want to buy homes, and they certainly want to refinance their homes. So it's just a matter of their financial situation, individual financial situations, to see if they can do it, if they can purchase or can refinance.
So the next topic we got, there's no article to reference, but I know we wanted to talk a little bit about, some of the layoffs that have been happening, expected layoffs that are still coming. Obviously, we're all kind of hoping that this is going to come to a head fairly quickly here with some of the promising or hopeful, at least, remedies to the coronavirus. But let's talk a little bit about the potential and the layoffs that have already happened, the expected layoffs still coming, and the measures the government's taking to help these families.
Right. Well, the government is they're putting all kinds of policies into place now. All of the companies that service car loans, home loans, boat loans, credit cards, they're all showing a lot of flexibility right now for people who are not only affected with the virus, but whose companies go out of business, the layoffs that are happening. I feel terrible for people in the travel, restaurant business, hotel business, the cruising industries. And, there's a ton of people out there who live paycheck to paycheck.
Right.
And, it's just a tough situation for them. And they know the government is trying to put things into place to send them money and allow them to not pay certain bills until they can get back on their feet.
I think that, you see a lot of businesses living paycheck to paycheck, and it's amazing. I would say it's surprising, but it's not surprising, right? That you see how much of a house of cards there are for a lot of these businesses, and not even if it's small business. I mean, I'm talking big businesses that they go a week or two or three without revenue coming in, and it's done. So, and my big fear with all this is that, especially with the smaller businesses, that even though this pandemic may pass faster rather than slower, which is the hope, but that there's not, my biggest fear is that there's not jobs for them to go back into because so many small businesses are not going to make it out the other side of this.
No, it's a real fear. And we all have to do our parts.
Absolutely. So fourth and final topic here, let me go ahead and pull back up the screen share here. And so Zillow has suspended their iBuying basically. And iBuying has been a very popular topic in the real estate community right now. And then actually OfferPad, Opendoor, Redfin looks like, well, it actually says here Redfin and Opendoor. I don't know if OfferPad followed suit, but it looked like, three of the major players in the iBuying field all temporarily halted their purchase of homes. So, what's your take on that? And what does that tell you?
I mean, it's smart of them. Obviously, they don't know where prices are going to go. They don't know how long this is going to last, and how many people are going to be affected. So I know that for us, we've had a number of buyers just walk away from their deposits because they weren't even laid off yet. They're just afraid of what might happen. So these are smart moves by them. Take a step out of the market until it settles, and then go back in to see that where values really are.
Yeah, I mean, there's so much uncertainty. There's no reason for them to put any more risk out there. I know we talked about on a previous show Zillow and their iBuying process and how little of their revenue was actually generated so far as the iBuying, and even on the mortgage side. There's no reason for them to take that additional risk in this kind of market and be buying homes when they don't really know what that landscape's going to look like coming out on the other end. But we did think it was very important news for not only loan originators to be listening to, but also for them to share those with their realtors, their referral partners, because it's a very important topic of conversation amongst the realtors in their community.
Right. And to me, anybody who's, whether you're a lender, title company, realtor, anybody who's doing anything in the real estate market, we should just stay in touch with everybody and stay very communicative. That's a word.
It's a word now.
You want to stay out there, stay in front of everybody, because people still want to buy homes. They just can't right now.
Right.
So, and even if this is a 2 or 3 month cycle to get through all this, in the scheme of things, that's really not that long. So the more you stay talking to people, keep people informed, be a resource for them, when the time comes, they'll be there for you.
Absolutely. Absolutely. So we've been encouraging our our loan officers internally to, get out in front of the realtors more now than ever, do, virtual calls with them, do Zoom calls with them, just, be that trusted advisor, the resource. There's so many questions that the realtors have right now, understanding the mortgage industry, the mortgage markets, the rates. It's really important that we are in front of them, and also our customers, obviously, now more than ever, and as advisors. And the show must go on, and our show must go on. So, Howard, I appreciate you joining me today. And
it's great seeing you.
No hazmat suits and everything. So looks like we're coming out of this on the other side. I'm very optimistic. I'm always optimistic, but we've been seeing some really good news lately in the past couple of days here. So hopefully it'll be back to business as usual before too long.
Hopefully, and I'm sure we will.
All right, guys. Well, thanks so much again for joining us on this episode. We look forward to seeing you again next week, same time, same place. Have a fantastic day.
Thanks a lot, guys.
Bye-bye.